Good morning, good afternoon, and good day, everyone. Thank you for joining us on today's webinar for the new FASB RevRec standards, Actions You Should Take Now. We are in the midst of grappling with the biggest accounting change in decades. And what we hope to do in today's session is to provide you with a firm foundation to help you understand the changing RevRec standards and ASC 606, and also provide to you some concrete actions you can be taking now to make your transition a little bit smoother. My name is Vijay Ramakrishnan. I am from Intact, and Intact is a provider of best-in-class cloud ERP software. And as a company, we're strongly focused on the needs of finance. Intact is the preferred provider of the AICPA of financial applications. And as a company that's focused on finance, we have been following ASC 606 for years now, starting from its days as an ASU, an update a few years ago, because we knew that these new standards represented a fundamental change in thinking about accounting, and we wanted to get ahead of those changes for our finance customers. So with me today, I'm happy to say, is Frank Pasacreta. Frank is a partner at Frank Rimmerman, and he is our featured speaker, and he's going to be providing you with some great information. Frank, I'll hand it over to you for a brief introduction.
Well, thank you, Vijay. Hello, everybody. I am Frank Pasacreta. I'm an assurance and advisory partner at Frank Rimmerman, and we were a full-service firm located in the San Francisco Bay Area. We have 4 offices, 375 people. Our tax practice is focused on high-net-worth individuals and their families, and these are folks that founded Silicon Valley and continue its legacy. From a business practice standpoint, we're focused on venture firms and the industries that they invest in, software, internet, technology, medical devices, and our business systems consulting division is a proud Intact preferred partner. So, very happy to be here.
Great, and Frank will be back with us shortly in a couple of minutes. What I wanted to do next was just to provide a brief roadmap into what we're going to be covering today. I'll be covering a couple of logistical items, and after that we'll get on to the heart of the webinar, and Frank is going to provide for you an overview of the 5-step process that's really at the heart of the new standards in ASC 606. And after he covers that, I'm going to be coming back onto the webinar and discussing with you some of the factors that you should be thinking about in terms of timing your transition activities. And I'll also be covering with you how you can accelerate your preparedness and make your transition smoother with the help of automation. In terms of housekeeping tips, welcome your questions. We're doing this webinar for you. So if during the course of the webinar you have questions for Frank or for myself, please feel free to use the chat box or the Q&A box on the webinar console. We'll try to get to your questions during the course of the webinar, and if we don't get to your question, we will follow up with you afterwards. Also in follow-up, we'll send a copy of this presentation to you and a recording of the webinar as well. Please do take a few minutes at the end to fill out the survey. If you will be requesting CPE credit as part of your attendance here, please note that you do need to attend the event in its entirety, and the survey at the end of the webinar is very important, as that's where you'll be able to provide your license number and contact details, which we have to have in order to process your CPE credit. And so with those preliminaries out of the way, let's get started. But let's get started with a polling question. And so just so that we can level set our discussion and our conversation, let's start with a poll. And that polling question is, what is your current knowledge of the new revenue recognition standards? Is it from a spectrum of A to E, from limited, very limited to limited, neither limited nor knowledgeable, or are you fairly knowledgeable in terms of knowing what these standards entail and how they will impact you? And so we see your responses coming in right now, and it's pretty interesting what we're seeing here. We're seeing a fairly even distribution amongst the first four choices, which is interesting, Frank, because I think what this indicates to me is word's getting out, and people are beginning to, make some very concrete preparations and assessments as it relates to ASC 606 and the new standards.
I would agree. It's in previous webinars that we've had together, very limited and limited. It's been probably 70%.
Yeah.
And right now we're hovering around 50, so that's very positive.
Yep, because it is something that's important to get ahead of, and so that's a message we'll be coming back to during the course of today's session. What I'd like to do at this point is hand the floor officially over to Frank, and Frank is going to cover the first substantial portion of the webinar, which is to give you an overview.
Great. Well, this presentation is 16 slides, which doesn't do justice to the complexity of ASC 606. And if you take a look at where this started, it's ASU 2014, which means it's been around a very long time. It came out in May, and the FASB and the International Board have done a lot of tweaking, and my slides are up to date and current as far as where we stand with the pronouncement. This is really focused and tailored for software, but it does impact almost every industry out there, but we're going to spend some time in diving into the software revenue recognition. We're hoping to see the final standard from both boards by the end of 2016. That's what they keep telling us. We'll talk about that later. Okay, let's look at the five-step process. So there are 5 steps for revenue recognition. The first one is let's identify contracts with the customer. Second, identify the sets of performance obligations that are embedded in the contract. The third is determine the transaction price. 4, allocate that price to performance obligations. And 5, we can recognize revenue as we perform those obligations. This is a very, as you say, a very huge revenue standard, and we haven't seen anything like that since SOP 97-2 in 1997. So sweeping changes across the board. It eliminates the very specific guidance by industry, and it puts it into one comprehensive recognition model. So, and it's really to align with IFRS. So from a software standpoint, it gets rid of our software revenue recognition, ASC 985, and multiple element arrangements, which is ASC 605. So if you're in software, those two standards you've known to love and hate, they will no longer be available to us. But the good thing is that if you know your multiple element arrangements, the guidance that's coming out is going to be pretty theoretically aligned with what you're used to. So this is the guidance. Why is it happening? Well, you've got GAAP and you have IFRS. And GAAP is considered fragmented, voluminous, complex, which we would all agree. The world sees that as the way we operate in the U.S. And on the other hand, the U.S. sees IFRS as difficult to apply because it's very general in nature with very limited guidance. And we in the U.S. need guidance. It replaces the 4 existing criteria for RevRec. 1, evidence of an arrangement. 2, delivery has occurred. 3, price is fixed or determinable. And 4th, collectability is reasonably assured. So 5 steps versus the 4. So let's take a look at the adoption methods for 606. You can apply it either retrospectively, so that would apply it to each period being presented, or you could have the cumulative effect, which is a change in accounting method, which would apply the guidance at the date of adoption, which is easier. However, you're going to have significant additional disclosures to inform the reader of what's happening and what has happened. So from an accounting change standpoint, you're going to have your standard accounting disclosures. It's going to require a qualitative discussion of changes in the reporting between the current GAAP and ASC 606. So to do that, you're going to have to maintain two sets of books. You're going to have to give very detailed revenue information by your sources of revenue. And you're going to have to identify significant judgments and estimates used by management. You're going to see, Vijay, a lot of judgments and estimates that are used by management, which scares me. It scares me as an auditor because I have to use judgments and estimates too. The problem with those is that hindsight is always there to tell you if you're right or wrong. Mm-hmm. Focus really on what you did wrong from a management standpoint, right, and a reporting standpoint. So you're really going to have to take a look at your current accounting system, because Excel-based systems is just not going to work. Yep. If you have two sets of books, you've got double the amount of work, forgetting the fact that, hey, you've got all different things to worry about as far as internal controls, lines of reporting, the way you present your contracts to customers. There's a lot of things out there that are going to be impacted as you're implementing 606. Software companies that have not dealt with VSOE, have not established VSOE, they're going to be significantly impacted by this.
Yeah, and Frank, if I may interrupt just for a second, this is one of the reasons we started looking at this fairly early, is because we knew that in order to effectively, apply, this process and adopt the new standard, there's just a lot more information that needed to be tracked in a very controlled way in order to support any of those judgments, as well as, from an automated perspective, apply the right accounting treatment at the right time.
So. Right. So let's move on, take a look at each of the steps. So the first step is identifying the contract. And a contract is an agreement between two or more parties that create enforceable rights and obligations. Each of these bullet points must be met for revenue recognition under 606. So the parties have approved the contract, and they are able to commit, and they are committed to performing their stated obligations. So each party's rights can be identified because we have to assess performance obligations. What are we buying into by signing this contract? Third, the payment terms. They must be identifiable. 4, the contract has to have commercial substance. It can't be between parent and subsidiary, as an example. And the 5th one is collection of consideration is probable. This is, again, dealing with all industries. There are some that are excluded. Leases, insurance companies, financial instruments are carved out because they have specific requirements in the literature. But we are really looking at a lot of work to figure out what's the difference between new GAAP, current GAAP, and new GAAP. The good thing is that as we're looking at our contracts, the FASB has allowed a portfolio approach. So you can use it as a practical expedient when you have contracts with many customers having similar terms or conditions, which means our paper versus their paper there's going to be a big difference. If you can use your paper, get customized or standardized contracts, the implementation and review for 606 is going to be much easier. Collectability, again, is in the first step. So if you don't have assured collectability, revenue recognition cannot be met, and any changes in collectability could result in the contract no longer being enforceable. So they're trying to make sure you have a real agreement between two parties. Okay, so let's look a little bit more closely at collectability on this slide. So you have to assess if the price is probable of collection at the contract inception based on your customer's ability and intent to pay the amount that are due. it's not based on collecting all consideration in a contract. You still can have an allowance for doubtful accounts as an example for a receivable. But you want to look at the ability for your customer to pay, and your ability, by the way, to demand advance payments or to stop providing goods or services for failure to pay. If collectability is not probable, you cannot recognize cash collected as revenue until there are no remaining obligations and substantially all consideration is received or the contract has been terminated. What we mean termination is that you have the ability to stop providing the goods and services to the customer. Vijay, what this means is that cash basis is no longer acceptable.
Right.
And that's a huge difference, huge change going to 606.
Yep.
So collectability is embedded in that first step as far as contracts go. Let's take a look at an area that's most concerning when it comes to step number one, and that's contract modifications. So this is where really the first slide where we're going to see a lot of judgment and estimates made by management. So contract modifications under 606 can result in cancellation of the initial contract and recording of a new contract, or it could adjust revenue either cumulatively or future revenues. So this is a wordy slide, but it really, I think, drives home the effect of contract modifications. So in the first one, we have a separate contract that has distinct goods and services, and we'll define distinct in the next slide. And we're adding additional goods and services to that contract price. The key here in this one is that they are at standalone selling prices, another new term. But what happens here is that in this contract, we're scheduled to deliver product A. And we're amending this contract to also add product B at its standalone selling price. Since there's no change in our commitment to provide product A, and there's no real pricing decisions to be made on B, we're going to look at the addition of B as a separate contract under 606. Okay, so the second one, which does impact your revenue recognition, is the fact that we have, this is an example where we have 300 seat licenses delivered over 3 years for $600,000, which is $2,000 each. So we're 2/3 of the way into it. We've delivered 200 licenses. We've recorded $400,000 in revenue. So in year 3, we want to incentivize the customer to add more seat licenses. Okay, so we're going to give a pricing concession to do that. So we're in year 3, we're going to modify the remaining 100 seat licenses down from $2,000 to $1,500 each. To do that, we want the customer to buy 500 more seat licenses over the next 2 years at $1,200 each. The key here is that the current selling price for the seat is $1,500. So given the seat licenses are not distinct, we have the pricing concession, we are modifying the original contract, and a new contract is created. So the future revenues, which will be generated by this new contract, is $750,000. So we have $150,000 with the remaining original 100 seat licenses, plus we're going to add the 500 more at $1,200, which is $600,000. So in the future, we're going to recognize revenue ratably as the seat is delivered at $1,250 per seat. Okay, so again, there's a lot of contract modifications that can happen along the way. That in this case, you have to really look at each contract modification and determine its effect on revenue recognition. Much more complex.
Yep.
Okay, so let's move on to number 2. Step 2 is identifying the separate obligations. And what we have to do is think a performance obligation in terms of deliverables under the current wording of our standards. So a performance obligation is a promise in a contract to transfer a good or service to the customer. And the good or service has to be distinct, okay? Or it's a series of delivery of distinct goods and services, such as the seat licenses that we had on the previous slide. The two requirements for being distinct is the customer benefits from the good or service on its own or together with other resources that the customer has readily available. The second is that the promise of transferring the good or service is separately identifiable from other promises in the contract. So again, we're looking somewhat at very similar to multiple element arrangements, but we don't use that term anymore. And what we want to do is we want to use our best judgment as far as what a deliverable is. What is the customer expecting from you in this contract? So let's look at the key differences in AS 606 as far as revenue for software companies is concerned. And these are pretty substantial, pretty exciting actually. The first one is implicit promises. So remember adding roadmaps to your deliverables with your customers was a big bad no-no, because that would defer a ton of revenue in that contract because they don't exist and you don't know what the pricing is going to be. That would defer your revenue until that deliverable is delivered. In this case, what you have is an additional performance obligation under 606 if you can expect that the additional goods or services will be delivered. And so what we're going to have is we're going to carve out that implicit promise or that roadmap item, and we're going to call it a separate performance obligation, and we're going to take the portion of revenue associated with that future deliverable and defer that portion only. The second area is acquiring additional goods or services. So if it's reasonably, you expect reasonably that a customer will exercise the option, you can provide up to 500 more seat licenses. What is the expectation that the customer will perform? Will it get no more additional, or will it get 500 more seats? And that you have to build in at the inception of the contract, that expectation. And you're going to recognize that carved out portion of revenue as you deliver the additional goods or services, or when that option expires to acquire additional goods or services. So that's a big difference also. The other thing is non-performance activities to administer a contract. These are the administrative things that you need to do to get the customer contract up and running, the setup of the contract. That is not a separate performance obligation because there's no delivery of a good or service to the customer. So that's another thing to remember. So your setup fees, they don't exist anymore. Mm-hmm. So those are the big three things, the key differences on current software and 606. So let's move on to step 3. And step 3 is determining what the transaction price is. So we're going to look at 4 areas where S606 differs from current guidance. So the transaction price is the amount of consideration which you expect to be entitled to for delivering the promised goods or services to a customer. You have to use your standalone selling price, which is not based upon list price, because we know that there's a lot of discounting that goes on in the industry. The other thing you have to worry about is variable consideration. So this is estimated at the contract date, and every reporting period you're going to reassess the probability of getting additional variable consideration under the contract. Again, management judgments and estimates. They give you 2 options for variable consideration, the expected value and the most likely amount methods. These are not policy choices. You have to take a look at each contract and determine what method is most appropriate for that contract. And the method has to be applied consistently throughout that contract. The key wording in the standard is that you estimate variable consideration to the extent it is probable that a significant reversal of the cumulative revenue will not occur, which is kind of a backwards way of backing into, well, it is a backwards way of backing into it. Very tricky wording, but you have to work hard at the inception of the contract to not have a material adjustment during the contract term that's going to require reversing revenue. Okay, and that's a tough thing to worry about there, an important thing to worry about. Non-cash consideration is also different under 606. And what you're going to do there is look at any customer equity or contributed goods or services that the customer will provide under the contract, and look at it at the beginning of the contract and then measure it based upon its fair value. You don't change revenue recognition for a change in estimate. The key, though, is that if you do have changes in the value of your customer equity, you have to record that during the contract term as it's occurring, but it's a gain or loss of operations. It's not an adjustment to revenue. And that goes along with fair value measurements, that theoretical approach to it. So those are things. Oh, the last one that's on there is significant financing component. If you remember under the current GAAP, if you have payment terms that differ from your standard payment terms, it could defer revenue recognition, because it's putting a question as to whether will the customer have leverage against you to provide more services by withholding your payments. The key here is that the practical expedience is if you expect to get payments within 1 year of the contract signing, you can recognize revenue under 606. So that makes our lives a lot easier from that standpoint. So those are 4 areas that are very different under 606. Let's take a look at variable consideration. That's volume discounts, rebates, refunds, incentives, pricing concessions, royalties. It's based upon your estimate of what your normal customer business practices are with similar clients. So if you think you're going to get these additional revenue items, what you're going to do there is you're going to build it into your deliverables and allocate revenue for it. So you have to reassess this, VJ, every reporting period, which again puts a lot of pressure on your staff and your accounting system.
Yep.
The 2 acceptable valuation methods, expected value, it's a sum of probability-weighted amounts in a range of possible amounts. So you have a large number of similar contracts. What's the expected value of? The other one would be if you have one outcome, yes or no, you'd use the most likely amount. So if you were to get a bonus or not, that's when you would use most likely. So you could see why it's not interchangeable. You have to look at each contract to determine what the acceptable valuation method is.
Yeah.
Okay?
So Frank, if we may, before you move on to step 4, obviously a lot of changes here so far that you've talked about. It actually prompted a question from the audience. Maybe you could address it generally, which is there a minimum value to contract price that would make ASC 606 not relevant? Like when do you, practically speaking, maybe when do you not need to care about it?
Well, this is one thing that was, that's a great question, by the way. This is one thing that was clarified by the FASB in one of the amendments, and that is that you don't have to worry about things that have minimal value. They don't define what minimal value is, but it really is your judgment call as far as if it's not material to the overall contract price, then you don't have to worry about carving out all these immaterial deliverables and really concentrate on the major areas of the goods or services to be delivered. Yeah. So that's a great question. Okay. And there was a lot of worry about that as far as adoption goes. You have to go into minutia, and that's not what the standard is, because it's a general standard, not a detailed standard, right?
Right.
So great question. Thank you, audience. Okay, step 4. We're getting close. We're going to allocate the transaction price now that we know what that pricing is. So you're going to have to determine the standalone selling price at contract inception of each performance obligation, allocate the transaction price on the relative standalone selling price of the items within the contract, and if a standalone selling price is not observable, an entity must estimate it at the contract date. The big thing here, you've got discounts, you have variable consideration. You really just not looking at adjusting the original transaction price for subsequent changes in standalone selling prices. And we're going to talk about standalone selling prices on the next step. But you have to reassess variable consideration, as we said, at each reporting period, and that assessment can change revenue recognition throughout the contract. So that said, let's look at standalone selling price. You have to use the entity's customary business practices to determine standalone selling price. As I said earlier, it's not your standard list prices. The big thing here, another change, big change with 606 is there's no three-tier hierarchy anymore. So we're not going to have BSOE. We're not going to have third-party evidence. We're not going to have best estimated selling prices. Big change for the software industry. So what you're going to do is you're going to really default right down to best estimated selling price, which is why that was incorporated a few years back into the literature to make this transition smoother. So you're going to use all available data, maximizing the observable inputs to estimate your standalone selling price if you don't sell it separately to your customers. There's two suitable methods to determine it: adjustable market assessment and expected cost plus margin. The methods should be applied consistently. Discounts are allocated based upon standalone selling prices unless there's evidence that you can bundle some things like one or two variables and then discount just those two items. But normally you're going to do it relatively across what's being delivered. Let's take a look at the revenue. Now we can look at what revenue is. We're going to recognize the revenue after steps 1 through 4. An entity should recognize revenue when it satisfies each performance obligation by transferring that promised good or service. A good or service is transferred when the customer obtains control of that good or service. So this one here was really something difficult for people to get their arms around, because when does the transfer of the promised good or service occur? And you're really looking at ownership, at the risk rewards of ownership. You can record it over time or at a point in time to determine that at the contract inception. So how is it delivered? What are the transfers of risks and rewards of ownership for each of the contracts? So control is the ability to direct the use of and obtain all remaining benefits from the good or service, or it's deploying or allowing others to deploy, or restrict the right to use the asset from others. So this is an area that was really, really at the forefront of people's concerns, and for good reason. But from a standpoint of what our industry is dealing with in software, the next slide is really important. And the FASB has said, gee, there's so much going on. It's figuring out what IP is being contracted for. Let's draw a really bright line for the users of 606. And so the next slide is really a wonderful slide for the industry. And so the right to use a license or a right to access the license has been broken out into functional IP and symbolic IP. And that is, functional IP is software, drug formulas, completed media content. That's what that definition is. And the symbolic IP is branding, team or trademarks, logos, franchise rights. And so what happens is that the bright line is drawn where if you have software license that is being contracted out for, what you're able to do is you're able to recognize it at the point of time, which is the signing of the contract. That should really be a boon for our software companies, because that's accelerating revenue that they would have had to defer otherwise. So a very large change and a very important change for the software companies, licenses. Yeah. And so if you have, you know, your SaaS model, this is not part of that. But if you have your licenses, whether perpetual or time-based, you will be able to recognize that portion of the deliverable separate from your support and services, for installation and things like that. So it's recognized at the inception of the license.
Right. And so, Frank, just to reiterate a point that you made, here we're talking about, software companies offering licenses. There's a general question that came in from the audience, and I'm wondering if you could offer your general thoughts on this, which is, we talked a little bit earlier on the previous slide about control, right? So how is control defined in the SaaS cloud-based model?
The SaaS cloud-based model is that the customer has the right to use it. It doesn't have the right to acquire.
Right.
And so you're hosting a service. You're not allowing them to take rights to that license,
right.
that IP.
Right.
So there's a huge difference between a license and a SaaS model.
Okay. Okay.
And so the change to 606 should not be that dramatic when it comes to SaaS companies. Some may not see any difference at all.
Depending on the structure of their contract.
Exactly.
Right.
Exactly.
Right.
Mm-hmm. So where are we right now? Here's a slide that's everything that we just talked about in the slides is what's happened since May of 2014. These things are FASB related, not necessarily related to International Accounting Standards Board. And so IFRS will differ from the FASB 606 when this is finally released by both of the boards. And those differences are supposed to be minor, but we won't know what they are until both boards issue that statement. So the last slide gets us to where we are right now. And what's happening now is that they are deliberating and really looking at illustrative examples by industry of how to implement 606. And so there is a software task force, and this is what's deferring the date of implementation is that we in the U.S. need illustrative examples. And that's what's being worked on right now. The next meeting that the FASB has is on 11/6, and so November 6th or 7th. And so we won't know anything until after that date, but there's no indication that the boards will not issue the final standard by the end of 2016.
Right, right. So this is coming, even though it's been delayed once. It's coming around.
Yep.
I wanted to make a clarification, and then that was the point, Frank, that you made around the accounting for licenses. There are differences in the so those are some differences you talked about. Those are specific to licenses. When it comes to subscriptions and SaaS, there's some changes as well, right, from a practical perspective, and I'll be getting into those. So I wanted to reiterate that clarification that ASC 606 is going to have an impact, on all types of software subscriptions and licenses. The point you were making there was just, the point you were making specifically about licenses.
Correct.
So what I'd like to do at this point is let's turn to another polling question, which is now that you've got a little bit of a view into what the 5-step process entails, what do you expect to be the biggest challenge of implementing the new standard? Is it implementing the new guidance into your system or spreadsheets? Is it training the folks on your team that are responsible for this, identifying the performance obligations, allocating the transaction price to performance obligations, or is it considering contract modifications and how you want to be handling those? So we have the responses coming in, and give another second or two for folks to enter their results, and we're seeing the results come back in right now, and by far the number one choice that people have made is implementing the new guidance into your system or spreadsheets.
Right.
There's changes in what needs to be tracked. There are changes in the accounting treatments that you may need to apply. So that's certainly beginning to hit folks here in the audience in terms of, that being a significant challenge. And I think the second choice, most popular choice, was allocating the transaction price to performance obligation. Any commentary on this, Frank?
Well, I understand completely why D, allocating the transaction price, would be second, because you really have to look at your contracts and your customer relations, and it's an entity-wide discussion.
Yeah.
Not just a finance discussion.
And we'll get into that. We'll get into that a little bit later. So, Frank, I wanted to thank you for that solid foundation here. Where I want to take the conversation next is looking at some of the things that you need to consider from a practical perspective. For those of you who haven't gotten started, how to get started. For those of you that have started, how to accelerate your preparations. And, at Intact, we think there's a few different things that are important in terms of the whole area of revenue recognition and especially making this transition. One of the things to try to get a handle on is the fact that the data that's going to help you make these judgments, but also make these determinations around when to recognize revenue is being captured in lots of different systems. So, your CRM system where, your orders and your renewals and your subscriptions and your add-ons are originating, that becomes critical to have a tight link between your CRM system and your financial management system. But the other piece of it is automation, right? As you make these judgments, as you determine, the judgments and how you want to apply ASC 606, you don't want to do it on a contract-by-contract basis, right? Because if you're like a subscription business, your business is growing, and so rather than sort of encapsulating these as one-off things in spreadsheets, you want to be able to leverage automation to have that consistency, but also to make your audits go faster, right, in terms of, controls testing and all those kinds of things. That's really important. The other important thing about ASC 606 is predictability, because for some SaaS companies, the actual numbers for revenues, expenses, profits are going to change, right? And so it's important to have this predictability into how the numbers are going to be impacted, and beginning to communicate about those changes, with your investors, with the board, but also, thinking about revenue planning and expense planning. So we'll talk about that a little bit more. So there's three things that are important to think about as you think about when to get started. The first is, let's just go back to looking at the regulations and the effective date for the reporting, right? So for private companies, period starting after December 15th, 2018 is when you'll be impacted by the reporting requirements. For public companies, it's a year earlier. And there's, an optional, reporting date as well. As you look at these dates, on first pass, they may look a little far out, right? But the thing about it is it's important to hold these dates up against the terms of the contract, the duration of the contract that you're writing today. If you're a private company and, you're writing 3-year agreements with your customers, or if you're a public company and you're writing 2-year agreements, you are already writing contracts that will be impacted by the new guidelines. And this is significant because part of making the transition is having to do that dual reporting. And Frank, you referenced this when you talked about the full retrospective method and the modified retrospective method earlier. As you make the transition to adopting these new guidelines, there's going to be a period of time where it's important to either report or disclose on the specific impacts of these changes. If you adopt the full retrospective method, that means that all the years presented be restated as if the new guidance had been in effect since the beginning of that contract, of that agreement. There's a modified method where you can record the effect of making this transition at the date of adoption, and then providing the disclosure behind it. But either way, whether you're applying, the modified retrospective or the full retrospective, what's important to have, either to state formally in the results or as part of the disclosures, is the granular and specific impact of those changes on your contract. So from a timing perspective and beginning to think about ASC 606, remember that the subscription contracts that you're writing today, depending on their duration, may already extend into the period where they're going to be needed to be treated that way. I want to get to a couple of other considerations around preparation as well. But before we do that, let's just get a feel for when folks in the audience, I want to do our third poll, is when do you expect to start implementation of the new rules? So have some of you already started or are looking to start in the remainder of this year or perhaps next year or in 2018? Or are there some of you who just haven't put enough planning into this, so you haven't had plans around this? And so give you guys another few seconds to look at this, and then the most common answer, nearly half of our attendees expect to start next year, and so I think that's fairly positive.
It's a wise choice.
Yeah, in terms of getting going, and then there's a few of you who are planning to start earlier than that as well. So dual reporting was one reason to get going now, but there's a few other reasons as well, and I wanted to touch on these. And Frank, you referred to this earlier, which is this is an accounting change, but it's an accounting change that has ripple effects on the entire business. And certainly within the finance organization, you want to understand the 5-step process. You want to understand, how, the accounting rules are going to impact your results. But you also want to begin to understand from a technology perspective, both within just your financial management system as well as other systems in the organization, start thinking about how these systems are going to need to talk to each other, start thinking about how the processes between finance and sales, for example, are going to need to mesh and work together now, because ultimately there's things that need to be done on the management side. The board, the executive team needs to understand the business impact of 606 on results, need to be proactive in communicating with investors about that. In fact, I was talking to a CFO earlier this week, and there's a change in their business where they're now beginning to write longer-term contracts. Previously, they were only signing, duration of 1 year, but now, they just made the switch to 3-year agreements. And he's like, what he's doing is he's actually now preparing for the board 2 different perspectives on the revenues and expenses related to this contract because he knows 606 is coming. And so, this is something that you need to start engaging, with the management team on and making them aware as well. And from a sales side, one of the most important impacts is around the amortization of expenses related to securing the contract. So things like, sales commissions or even royalties, the way that expenses are treated may change as well. And so you want to think about this from the sales perspective. So there's this issue of dual reporting. There's the issue of, this is a cross-functional kind of impact where management needs to get involved, sales needs to get involved. But there's a third reason where you want to really accelerate your transition around this, and I think that it has to do with some of the specific accounting treatments, right? We talked about what it means for licensed companies, but there's impacts for subscription companies as well. There's no more revenue recognition on cash receipt. That's for those of you who have been relying on that. That's an important change to be aware of. But for those of you who have multiple element arrangements and maybe are offering services at a discounted rate, and then in a few months later you're adding on subscriptions to that original contract, that impact of that discount may need to be reallocated upon changes to the contract. We talked about a little bit of the more regular deferral of contract-related expenses like commissions, like royalties. And so these are some of the accounting kinds of changes that are going to result in different results according to ASC 605 and ASC 606. And that's what the dual reporting is for. And of course, there's going to be impacts on forecasting and how you think about revenue planning as well. And so the third reason to get ahead of all this is because for a lot of subscription companies, there's the accounting piece of this, but there's also the billing and the reporting piece, right? So if you look at some of these changes that are coming using, with respect to adopting ASC 606, if you are today already relying on spreadsheets for managing revenue recognition in the 605 world, and you're looking at making this transition where dual reporting is going to be important, and you're looking at the accounting rules that you apply changing, you may be coming from a place where you're already using spreadsheets to do billing for things like usage-based billing in the finance organization. You're already using spreadsheets to do accounting and all of your forecast reporting. If you think about layering on top of this the fact that for a lot of subscription companies, the business is growing, so there's just more and more contracts, that's great news, right? But if you're still relying on spreadsheets and your business is growing, you're trying to make this transition, then it's an issue, right? Because you're going to be overwhelmed with spreadsheets. And so we saw this problem coming at Intact, and so what we wanted to do is we wanted to help with automation. And so what we brought to market earlier this year was Intact Contract and Revenue Management. And this is the first automated solution in the market to automate all of these new complexities created by ASC 606 and IFRS 15 to help you handle and get your arms around doing all of these things in an automated fashion. Because again, doing these things and trying to handle ASC 606 using spreadsheets is not going to be a very effective way going forward. So just to give you a brief glimpse into how you can leverage automation, one really important and significant piece of automation that we've put into Intact is dual treatment. And that is the ability on a single contract to apply both the current and new revenue recognition rules simultaneously. And it's important for two reasons. One is you want to do this at the contract level because ultimately you're going to need to roll it up into dual reporting that you use to make the transition. So side by side, automated reporting that allows you to see your results according to both ASC 605 and ASC 606 at the same time. So that checks the box in terms of a compliance requirement, but what it also provides is the forward visibility into what results are going to look like. So from a management perspective, you can begin to think about, do we need to change our planning? Do we need to change our forecasting? Do we need to, and what do we need to, talk to the board about? So there's a lot of value in dual reporting from a compliance perspective, but also more generally from a reporting perspective. And so those are just to give you a flavor, two of the things that we've done from an automation perspective in order to make this transition a little bit easier. Now, with all of this automation around accounting, The reason we've been able to do that is because within Intact, we've developed a contract-centric architecture. And so the other name of ASC 606 is revenue from contracts with customers. And so if you hold that name up against our architectural approach, what we've done in Intact is, capture everything together in the contract. All the information that's related to the contract, being able to track all of the performance obligations, and by pulling everything together in the contract, we use a single source of truth to drive not just the accounting, the revenue management, and the expense management here at the bottom of the pie, but also use that same single source of truth to drive billing, right? And so not only getting the spreadsheets out of the accounting process, but getting the spreadsheets out of the billing process as well, and having a single set of data so it's a consistent set of information about your financial relationship with the customer that's driving billing, that's driving accounting, and that's driving reporting. And there's inherent value in that for creating accuracy, for eliminating the spreadsheets, and so there's a great deal of value you can do that, and applying all of this on a global basis, and also starting all of this from the initial point of data capture. For a lot of subscription companies, right, the very first bit of information about the customer relationship that gets recorded is in Salesforce, and there's no point in trying to rekey all of that information into your financial system. By taking Salesforce as the first point in which information comes in about this contract, and then very effectively being able to apply dual treatments and do the dual reporting, we have this solution here with Intact that addresses the complexities of making the transition, but more generally the complexities that a lot of subscription companies face in having not just to get the accounting right, and the accounting rules are changing, but also in terms of having to do the billing in an automated way, having to do the reporting around forecasted billings, around deferred revenues, around SaaS metrics, and all of those complexities as well. So there's a lot of value here in Intact in making the transition in a way that provides benefits around the accounting side, but also more generally for all the things that finance organizations in subscription companies are called on to do. And so with that, what I'd like to do is use the remaining few minutes that we have to address some questions from the audience. And so, Frank, we've got a number of questions that have come in here, and so let's look at a few that we want to address here. Let's start with what are your thoughts on this one? It's a general question about renewals of annual agreements. Should they be treated as separate contracts or changes to the original contract? Is there any guidance in ASC 606 about how to think about this?
Well, if a contract is renewable annually, you will have a new contract each year. And as far as a SaaS company goes, it's not. Again, you're not giving rights to IP. You're giving the client the hosting services that you would just bill ratably over that 1-year period. So every month you've earned it, you bill it, you earn it. So it's a very simplified way of doing things, but you also have to look at what's embedded in that contract. Do you have any more deliverables that you have to separately carve out and pay attention to?
Yep.
Okay.
Yep. Okay. So another question that came in. And I think I know the answer to this question, but let's just wrap it up. It's kind of on the same note. If you don't change the original contract but purely sign a new contract, do we still need to reallocate the original contract for RevRec? And if it is a distinct and separate service, right, and it's a distinct obligation, then there's going to be no reallocations and those kinds of
That
things.
is correct, as long as there's no pricing concessions, right?
Right.
So you have to worry about that, as we saw
in the example.
But that example, the first example, is spot on of what is being asked here.
Yeah.
If you don't have all those other things to worry about, which is add-ons at discounted prices and things like that, that's when it gets more complicated.
Yeah.
You know, what I like about the what I like what you explained is all the elements of the Intact software, because think of the learning opportunities that you have for the board if you can show side by side what the impact of ASC 606 is on a real contract that's existing.
Right.
So just thinking of that is really good for all the stakeholders to understand.
Right. Right.
Once a finance person hears or a board member hears that you're going to accelerate revenue in software,
right,
all the red flags go up.
Right. Right.
And it's important to explain that.
Right. Right. And how do you show and how do you explain that?
So there's a lot of benefits to having automation now versus a year from now.
Great. So wanted to provide a pointer to a few additional resources. We do have a wealth of information around ASC 606 on intact.com. I invite you to take advantage of some of the white papers that we have, as well as additional webinars. And if you need to reach Intact or Frank Rimmerman, wanted to leave you with this contact information. And with that, I wanted to do two things. One is thank you for attending, and remind folks to complete the survey as you exit, especially important if you are going to be getting CPE credit for today's session. And with that, I wanted to thank Frank Passacrita for being with us. And on behalf of Frank Rimmerman and on behalf of Intact, wanted to wish everyone a great rest of the day, and we hope to see you again soon.
Goodbye, everybody. Thank you.